Okay.
We've been getting lots of snow.
Yeah, in Switzerland, it's getting harder because it's getting warmer, and sometimes it hasn't have a lot of snow last week. It was enough, but it's some places. Last year it was better. Yeah, maybe wait for.
Can you guys see my screen?
Yeah, you can see it.
Yeah.
Okay, cool. Okay. Oh, shoot.
I kicked myself out. Sorry, I'm back. So let's start. So yeah, I already see the presentation from Nick on the screen.
Yeah.
So welcome to the research meeting on 24th February. Today we have Nick Pye, who sent us a convex Lydo strategy, I think. And then we have Forgiven, who presents us topics. I did a lot here about topics, but I've never had time to research, so I'm looking forward for this one. And first I go into some news and updates. So we have been working in the background on a new product, and after the two presentations, Charlene will talk about the new product we have working on and explain what we're doing. Then, so we have, this is like, we do it after the research, after the two presentation. Then there was like another vote for the Boule members who contribute most for the Alving DAO build community. And I myself, I've been again on this list. So thank you very much. And the thing is, if you pay this out to you, so if you're on the winning list of 3 people, and if you're on the list, then what we do, we don't send it to you directly, so we stake it for you. So if you connect with your wallet and then go to the staking on Alving DAO app, you will see it staked. Then we will have one more research meeting next week, and then we're going to close this intermediate round, and we will have a big voting about all the process strategies, the strategies who have been proposed. And you're still free if you didn't present, but you did like listen to this course and you didn't present strategy, you are also free to hand in a strategy in a written form. And then the following week, we will have the candidates who applied as new Boule members on the call, and they will present a project and present themselves who they are. And then we will going to vote on these new candidates. Yeah, I think that's it. We have 4 candidates right now. Yeah, exactly. That's right. So if you know anybody, we are still open. So if you know anybody who wants to be a candidate, you can just reach an email. And yeah, just DM me, or I've sent around some information how to do this. So I kick it off. Nick Pye, yeah, you can start. Thank you for joining. And
Cool. Thanks, Martin. Thanks everyone for joining. I'll be really brief. I think I last presented a convex or Lydo strategy at the last presentation. This is just a more specific like implementation presentation of how we can bet on Lydo and staked ETH. And I think that within the context of our larger portfolio, this is a very low risk, decent reward strategy that I think we can just continue to earn yield on, like our core holdings of ETH. And I think that this is, I've tried to find a lot of different ways to get yield on my ETH, and I think that this is the best way to get yield on ETH without having to run an ETH2 validator. Oops. Okay, so shoot. How do I hide this? Yeah. Okay, so the proposal is just to convert ETH into liquid staked ETH. Okay, cool. So the proposal is to convert ETH into liquid staked ETH via Lydo, which is a liquid staked ETH solution to earn additional yield on top of ETH. So the first implementation is to stake ETH directly on Lydo.fi. And all these screenshots are from yesterday. They might have changed with the recent volatility. But so the base APR right now is 4.4%, and that is after they take out a fee. I think an ETH2 validator is closer to 4.8 to 5.4%, last I checked. So they're taking a little cut on top. The upside of just doing this is you only have exposure to one protocol. So Lydo is your counterparty here, and you do have to trust Lydo to not mess up their validators, not get slashed, and also implement withdrawals correctly, which I'll discuss later. But the upshot is that you only, with this strategy staking directly on Lydo.fi, you only risk exposure to Lydo. The cons are that you're basically getting just the base risk-free, quote unquote, risk-free rate for ETH, 4.4%. So the second implementation follows from the first implementation, which is you stake ETH directly on Lydo.fi, but then you can deposit that staked ETH, which you'll get back, and use it as collateral on the money market, like MakerDAO or Aave. Aave is going to have that soon. They're actually in a governance vote right now. And you will earn a carry because the interest rate on MakerDAO is only 2.5%. It's the stability fee in this top right screenshot. And so you'll earn the difference of 4.4%, and your 2.5%, and you'll be able to borrow DAI, which you'll then be able to put into additional farms. The problem with this is that this is technically pretty challenging to implement since you need to dynamically manage your liquidation risk. Ideally, you want to optimize your capital efficiency. So as your collateral value goes up, as the price of ETH goes up, you might want to draw out more DAI and vice versa. The upshot is you should be able to get higher APR. And this is something that I do manually for my own portfolio, but I don't do it in a automated way. So I don't know if it necessarily scales. And the third implementation gets you a little higher APR than the first implementation. This is a convex route, but you're going to take part of your rewards in LDO, which is the governance token of Lydo, which will ultimately control its treasury and this validator pool and basically the entire protocol. And I think that this is compelling because I think LDO itself is a bit undervalued. So to do this, you'll deposit ETH into the curve Steth LP. And the interesting thing to check here is to check this ETH Steth ratio here. In the past, this ratio has been as low as like 40 to 60%, 40% ETH, 60% Steth, because people, I guess, priced in a higher risk of Lydo not implementing withdrawals correctly, or Lydo staked ETH losing its peg. So that was a really good trade for a while, but in the last month or so, it's repegged and it's about 50-50, and you actually don't really get any edge converting your ETH into staked ETH like you did in the past, where you would actually get some additional staked ETH on top. So you'd enter into this pool, then you'd stake your LP token on Convex, and the APRs for Convex are down here in the second screenshot, where you'll take your APR yesterday was 5%, and that's split 50-50 basically between your base curve APR, which is your curve trading fees, which takes into account the appreciation of staked ETH as it's earning validator rewards. So I guess the way to think about that is that's basically half the APR of implementation one, because when you're entering the ETH Steth pool, you're selling 50% of your ETH for staked ETH. So you're earning 50% of the Lydo APR with your position, so this base curve APR makes sense. You're earning like a little bit of trading fees and mostly just validator rewards. in exchange, you're also earning some LDO, like LDO farm rewards on top. And I think the APR is only 2%, but these strategies are generally interacting with trusted protocols. You don't really have to think too much about your position. And with enough size that Aladdin DAO could use, you could earn like a good amount of LDO pretty quickly. So I guess let's quickly go into the risks using Lydo. So there's the counterparty risk. Lydo is a DAO. Technically, it's control, like there's a core team, but the LDO holders will long-term control the protocol. There's the smart contract risk. The biggest uncertainty with ETH2 right now is that Lydo will still need to implement trustless withdrawals. A trustless withdrawal means that any validator today will be able to withdraw their ETH in the future once the merge happens. But Lydo needs to implement this so that liquid staked ETH users can also get their ETH, and that's not a trivial problem. And the design space has changed a lot if you look into the forums. So there's definitely some uncertainty here, and I think that's why the ETH steth ratio can be somewhat volatile. But I've never seen it be more than a 10% deviation. Finally, here are the latest market stats in LDO. Circulating market cap 160 million, fully diluted 1.6 billion. It's locked up 10 billion of TVL. I think what's really cool about Lydo is they also control validators on other networks like Solana, and I believe they're trying to build this set of validator networks outside of just ETH. But I think if you just look at ETH, it's very compelling because one of the biggest things that's going to happen is when the merge happens, all the transaction fees that are being paid to proof of work miners today are going to go to the validators. So that 5% is going to look more like 10%. I just read this research report today from Coinbase Institutional where they were projecting an APR right after the merge of around 10%. And that should come down a little bit as more validators come online. But I imagine the base APR will be a bit higher than 5%. And that just means more revenue for the Lydo DAO. So the value should go up a little bit. Yeah, so I guess my recommendation is to farm a bit of LDO and enter into the Curve ETH steth pool with however many ETH we want to put in there. That ETH is basically not going to be liquid anymore. It's just going to be farming. So I guess we should just figure out how much ETH we want to put into that and be okay not having access to farm LDO. Okay, yeah, that's my presentation.
Okay, thank you. Yeah, I don't know. I think it's pretty straightforward.
Yeah, super similar to the last Lydo presentation Nick gave. Very impressive stuff. Do we have to like re-vote it in?
We have the idea is, we have we vote on all the strategies in one vote. I think in 2 weeks or so. So the idea is that we vote on all the strategies and then in one vote, and then the strategies who have been voted in, so that the person who propose it gets like 100k ALDI token as a reward. And then, but this is, we'll explain this again. So at this point, the voters have like to invest some of their ALD, so they have skin in the game. So we see how the outcome will be, basically. But one question is, you said it's not trivial to unlock to make the withdrawal after the merge.
Yep.
So there's a chance to fail. You think it could fail?
It could definitely
That's
fail.
not the case, but I think it could be much more complicated than. Yes, do you think so?
Yeah, it could definitely fail. So the way it works is, as a validator, you deposit ETH in to stake your ETH, and you do this with a new private key, and that same private key, or actually that seed phrase, will allow you to get a withdrawal key in the future. That's the spec, at least. So The problem with Lydo is Lydo stakes on your behalf. So Lydo technically
Yeah.
owns all of the withdrawal keys. So Lydo
Yes.
will have to figure out some like either like they'll have to figure out a way to pay back all the users or do it in a way that users will have
Yeah.
self-custody.
Yeah, it could be that it can't be implemented in a decentralized way, basically.
Exactly. And they're trying to do it
Yeah.
in a decentralized way with smart contracts. So
Yeah, of
that's
course.
not going to be easy.
Okay. And why do you suggest, you suggested to lock it up with Lydo directly, but you can market buy it. What's the difference if you market buy it on?
Yep. So you can market buy it, but
It's the same, basically. It's the same.
It's not compelling anymore. I like plugged in yesterday.
Yeah.
Like if you try to buy 1,000 ETH, you'd suffer negative slippage. But I think like 2 months ago, when it was like a 45, 55%, you would earn additional staked ETH for buying it.
Yeah. Because the pool has been imbalanced.
Yeah, a bunch of really big.
But now, not anymore.
Yeah, like in the last week, I saw like a bunch of big whales entered this pool, so it's rebalanced a lot.
Okay. Yeah.
I have
just the initial info there was like a discussion that Lydo has like they had a 1 year lock who ended end of December 2000 last year. So I just had there was some rumor in the market like maybe at the end of last year that a lot of Lydos are going to be unlocked, but they are unlocked now. Looks like.
So Nick, there are I think a few others projects doing the same thing, right? A similar thing but a different way, like a rock pool. Can you comment on them?
I haven't heard about those. Could you explain them?
Just I haven't really done deep research into this, but rock pool
rocket pool,
positioned as a more decentralized solution, right? For ETH.
Rocket pool, right. Rocket pool, you have to run your own validator though. You still have to like set up your own node, like set up your own server and do some like stuff on the command line. The nice thing about staked ETH is you can just interact with, like point and click. Rocket pool, you need to, instead of staking 32 ETH, you can stake 16 ETH and pair it with some amount of RPL, which is their governance token. And that allows you to start earning RPL tokens. And it lowers the barrier to entry from 32 to 16, but it doesn't mean you can put in like 3 ETH. And you still have to run your own validator. So it's not really, I think it's too technical for us to do unless we were to really dedicate ourselves to running a validator.
Okay. Yeah, the newest I did see yesterday that there's like there's a curve pool on Rocket ETH and Wrapped ETH from Lydo, staked ETH. Just opened up like 2 days ago.
That's an interesting one too. I haven't seen the APR on that.
Yeah, it's very fresh. I think there's a gorge vote going on these days. Or
Well, maybe we might want to do part of that. Maybe someone else can present on that. I think like the main reason I really like this strategy is it's pretty like trustworthy and across all of DeFi, and you have relatively few risk assumptions you have to make, and you just don't have to think about it, and you'll earn like your 5% on your ETH.
Yeah, and Lydo is quite set. There's like Stakewise is another, and but they never got traction. Basically, they work a little bit different, but they never have been. They didn't get this traction as Lydo had until now. Okay, thank you for presenting this, and happy day skiing then. And
thank you.
Take care, I guess.
Yeah, thanks. Thanks everyone.
So I think we switch over. I just assumed there are no other questions. Sorry. So we switch over to Forgiven, who present topics.
Yep. Hello. Thanks, Martin. Hey guys.
Hi. Hello.
So I'll share screen.
Yes, please.
Okay. Thanks. All right. Hello guys. Sorry, I haven't got a presentation here.
Hi.
Because Charlene called me today to supplement a candidate who actually got some other business. So I prepared to deliver the present the beginning of March, because at that time, kind of a full cycle, I've been through the DOPEX, but right now it's kind of close. So I'll kind of give you introduction of DOPEX first, but without the presentation, but like go through the website, walk through their product and my experience for the February epoch. Okay. So DOPEX is basically the abbreviation of 3 words: decentralized option exchange. Okay, so that's kind of D for decentralized, OP for option, EX for exchange. So DOPEX. So that's how it comes. This is their homepage, and it's basically okay. You kind of refresh. So let's say that they call it single staking option vaults. So basically each option has its own underlying assets. So here we see their own token, its own like reverse token for any losses that incurred during the process that was originally designed. And also they have like mainstream assets like Ether. That's what most of these products are. Arbitrum. They also have assets on BSC and Avalanche, but the TVL is not that big. So right now, the most popular options that people write is the call options write and buy. So it's the call options on Ether. You can see here the TVL is about like $34 million. So the liquidity is relatively good, and also like the capacity are fully used by the community or the option buyers. So I last checked January ones, it basically are bought out, and this time it's bought out too, but other products are not. So we can have a quick look here. So let's see the next liquid one is the DOPEX token itself. So we can take a quick look here. So basically how this works. So let's take Ether as example. So today is the last day for epoch February. Tomorrow the epoch will be open. Then you will be able to deposit Ether into different strikes. Generally they offer 4 strikes. So you put your Ether you want to deposit here. So that means you are writing options at this strike price, and the deposit Ether is the underlying assets. If the price of Ether surpass, let's say 2,500, your Ether will be bought out by other people. But when it's settled, it's basically night out, right? So right now, so in the beginning of February, I tried it out myself. I put 20 Ether and across the 4 strike. So for 2,500 put 1, 3,000 put 4. 3,500 is 8 and 4,000 is 7 ETH. Okay, so if the price ends up tomorrow is over 2,500, so this option will be executed. And how much will be executed depends on how much is purchased. So here you see for this strike, it's almost 100%, and for the rest, all the capacity has been bought up. So that means if tomorrow the Ether price ends up above $2,500, my 1 ETH deposit at this strike will be bought out by, executed by the people whoever bought the call option, and he will buy the Ether at $2,500, and my Ether will be given to him, and I will receive $2,500 plus the premium. Okay, so here I've received 0.01 Ether for my premiums. So the premium people you can see here, in total, there are about like 260 Ether deposited into the 2,500 strike, and with 26 ETH as the option premiums. So how does the option premiums comes? It's a very interesting process. Like it's different than what I thought originally, because like when you deposited the ETH into the strike, that means how much ETH of this strike can be bought up to. So 260 is the capacity you can buy, but what about like how much premiums will be got into this strike? It depends on first how many options have been bought during the whole epoch, and also it depends on the timing when option buyers buy the options, right? So I think in the beginning of February, the price is right around 2,500, and it soon the price took off. So not many people buy the 2,500 strike, because basically he has paid the full price differences plus the time premium there, right? But like when the price went down close to the end of this month, so people kind of buying up the call option again and use up the full capacity here, and basically all the capacity of the 4 different strikes has been used up, and the premium is actually decided by the timing of the option buyers buy the option, and the option price is calculated given the Ether price, the volatility, and different like parameters. They use an oracle that imported from their kind of partners, and this European options. So basically, the option will expire, and it can only be exercised on the date of expiry. And generally, the DOPEX simplify this option products into, like for this call option, they simplify this into 4 strikes, and then like say, okay, so for whatever people deposit into different strikes, that's what the capacity you could have, and the option buyers buy at any time before the expiry, and then like the option price will be calculated based on the Black-Scholes models given the time of the option buyers buy it. So it's quite random for like how much premiums you can accumulate through the whole epoch. But I mean, luckily, like DOPEX is tweeted by Tetranode, which has a lot of followers and liquidity and traffic. So basically, all the option capacities has been used up, especially in the Ether call option, like product. We can check out the other one, their own tokens DPX that has like about like 9 million. That the utility, the capacity utility rate is not that high. The most lower one, call options, only 57% bought up, and the rest is no more than 20%. Okay, so people seems pretty bullish Ether. Okay, and that's good for option writers, right? Because you have write options, you have deposit ETH and write call options and sell it to option buyers. As long as there are enough option buyers, and then you are kind of making money by writing options, and your capital has been utilized to a very good level. Okay. And then let's see the practical result. I put 20 Ether into different strikes. Given I don't want to lose my ETH position, I'm bullish, although the price went down recently. So I put most of my Ether at the far end of the strike. Okay. But apparently, when the strike price is more closer to the spot price for calls, you earn more premiums because people are paying more for the premium. Okay, so let's say for 1 Ether, I earned 10% within 1 month. Okay, if price tomorrow didn't end up above $2,500, this 0.1 is kind of pure profits. Okay, the rest, I guess, is guaranteed profit unless it's spiked. That's very unlikely, in a day, right? But you can see, you know, like for 3,000, that's about like 4%, 5% something. For ETH, that's only 1%, right? For the 4,000 strike, that's even less. And APR here basically tell you, you know, the returns, right? Here you got like 10% straight, right? 10%, you know, to the square of 12, to the power of 12, that give you about like 132% of APR. So the number is correct as well. Okay. So that's kind of give you the premiums you can earn. And in addition to the premiums you can earn, you still get a farm APY from their token itself, from the DPX token itself. And I've asked in their Discord, basically it doesn't matter where you deposit, which strike you deposit your ETH into. You can still, it only matters for the amount of ETH you have deposited into this product, and then you can farm the DPX on this APY. So let's say if you don't want to lose your ETH position, you should deposit most of your or all of your ETH to the 4,000 strike, which is hardly to hit in 1 month. And then you basically doesn't get much of ETH, but you can farm this. You make sure you have this 12% like DPX like farming reward, right? That's kind of pretty high for ETH returns in all the DeFi products, right? So for Lydo one, you got 5%, but here for pure farming, you got like 12, but well, still you have a chance to lose your ETH position if ETH price goes above $4,000, okay? So then we should check out, okay, you know, what's the possibility of losing my ETH position? Okay, so here I've downloaded the ETH price on a monthly basis. And then we can see the monthly change for the ETH price starting from back to 2016. So I've got about like 6 years data, 71 months. And also we look at, you know, I use ETH strike as kind of a percentage scale to do this statistic analysis. Okay, for the downside, I use like kind of for 200, because for their call options, they basically each, the difference between each strike is 200. We can take a look here for their call options. Their call options, or put options, sorry. Their put options just started for half month, and the liquidity is not much even for ETH is only about $1.3 million, $1.3 million. And we can take a look at their strike here. And one more thing I'd like to kind of introduce the product a little bit, that for the put options, the underlying you're actually depositing into the different strikes is not ETH. You're depositing stable coins, but instead of depositing stable coin directly, you're depositing on Curve 2 pool on Arbitrum. That means, right, so let's say if the Ether price went down below this certain price, your stable coins will be withdrawn to buy the ETH at this price for whoever bought the pool options from you. Okay, so here they use like 200 difference for each strike. So I use this for the statistical analysis here. Okay, 200, right? Let's assume the kind of time zero starting Ether price starting from 2,500, and then for the downside I use 200 as a difference. Okay, for the upside use 500, which is aligned with their product design. Okay, okay. So I'm mostly going to analyze like call options today, because the put options just started for half months. Put options can start it tomorrow again. And also, like, I'd like to like tell people who would like to participate in this product for the people who would like to write options. Your time window is at the beginning or the end of the month. Generally, it's at the end of the month where you can deposit your stable coins, Curve stable coins, or your ETH into the product at the end of the month. And once the window closed, people are able to buy options, but you cannot write options, and the options capacity is decided by how much money has been deposited into the different product line. Okay, and then let's go back to the statistical analysis to see for the Ethereum price fluctuations for its history during the past 6 years. If it's go down more than 24%, you have 7 months, among 71 months. Between 24 to 16, you have 13 months. Between -16 to -8, you have 6. Between -8 to 0, you have 6 months. And for positive, between 0 to 20%, you have 14 months. 20 to 40, you have 8. 60, you have 9, and beyond 60, you have 8 months. Okay, so for the months you're up, basically 55%. For the months you're down, you have 45%. Volatility is 44% on a monthly basis, and the mean return for monthly return is 15%. Okay, so let's see if we are selling call options and deposit ETH and selling call options, which means people can buy ETH at a strike price from us, and we deposit in ETH. Okay, because ETH is kind of our main assets in our Intrality. We can see if we let's say we started from 2,500, and if we sell like 20% above, there are like, so accumulated 55% the case you are not losing your let's say from 0. Okay, let's start from the spot price. You have like 63% of the case that people could actually ends up with profiting from your options. Okay, let's say if you deposit all your ETH into the highest strike, you only have 11% of the situation that you're losing your ETH to people who actually buy the ETH from you. That means, let's say this month, the beginning, it starts from 2,500. It only has like 11% possibility that the price goes up beyond 4,000. And in that case, even you deposit all your ETH into the highest strike, you will lose your ETH position and be converted into USDC or USDT at $4,000 per ETH. Okay, but that's very less likely. Okay, so this is the kind of the accumulative probability numbers that you can look at and decide, okay, how much confidence I want to have, or how much return I want to earn before I give up my ETH position. Okay, so for people who are the most conservative, want to return their Ethereum position, but at the same time to farm.
Just a second. You share.
Yeah. Go ahead.
You share. We only see the app side. You share.
Oh, sorry. Is better now?
Other sheets, or
is this better now? Can you see the full page now?
We only see the app. But you share. No.
You cannot see the Excel.
What should I see?
Did you see the Excel? Sorry.
No.
No Excel. Okay.
Let me.
Oh, I see.
No.
Sorry.
Yeah,
My bad. I'll start sharing
now.
Oh, right now. Okay. So my bad. So for the statistical analysis, I started over. I download the last 6 years Ethereum price here, and with the monthly returns, and
yes.
for the price differences here, I use like 200 for the downside, 500 for the upside, because that's aligned with the product design of Dopix. Okay. And then I put, let's see if the return is less than -24%, you have 7 months. Between -24 and the -16, you have 30 months. Okay, so this is kind of for each month drop into the range. And then let's say, okay, what if the accumulative percentage for this possibility? Okay, let's say for call options, I only care, right, if the price goes up, that I lose my ETH position, or I lose money to whoever actually buy the call options, right? If I deposit all my ETH at like 4,000, it only have 11% possibility I'm losing money, and 89% of the case, the ETH price will not go up above 40,000. Okay, because there's only 11% of the months that ETH went up 60% in the past. Okay, we are kind of learning from the history. Okay, so let's say the strategy one, the strategy one I propose here is because Aladdin Treasury holds a lot of ETH, we deposit all of our ETH into the high strike starting the beginning of the month. That means, let's say if this month starting from 2,500, because that's kind of the same of February, probably the same with March. And then we deposit all our each into 4,000 strike. And then the chance is very low you lose your ETH position or you lose money. Only 11% from the history statistics, okay? Because only 8 months out of the 71 months that ETH went up above 60% for that single month, okay? So most of cases, we won't lose our ETH position, but we won't expect that we can earn a lot of premium from the product, given we can see here. So see here, for the 7 ETH I deposit into 4,000, I only earn this little of premium. Even the options capacity has been fully bought up by the option buyers at like 100%, right? You see here, all the option has been bought up, but even in that case, you only have, this little premium because the strike price is too high. But that doesn't matter because you can still enjoy this 12.34% DOPIX farming yield. That's probably the highest in all market for Ether farming yield at this case, okay? And then let's see if we be a little bit more aggressive, So, okay, I want to risk some of my ETH position, or I would like to give up my ETH position for a certain level of returns. We can do strategy 2 here, which means, okay, I spread out my ETH across different strike. Okay, so when I look at the possibility here, the statistical analysis here, okay, I would say, okay, let's say, for spot, right, only like 63% of the case, 55% of the case, that's above zero. Okay, 55% because accumulative, okay, that's from 0 to 20. Accumulative 55% of the case, the price is actually higher than the spot, than the beginning of the month, right? I don't want to lose my ETH position, so I would only allocate 10% of my ETH into strike 1, okay? About like 20, and then like for strike 2 and strike 3, I probably do double the first strike and almost a little bit less than half in the last strike. So that means I maintain most of the upside, but also I could gain some like premium throughout the epoch if the ETH didn't end up up, right? But I mean, generally we'll expect Ether go up in the long term, right? So that you don't want to put too much ETH into the first strike because you will lose your ETH position easily, right? So like strategy 2, a little bit more aggressive. So this percentage is actually quite closer to what I'm allocating right now. Look at here. So here is like, here it's less than 10%, it's only 5%, right? 1 against 20. So I guess I can be a little bit more aggressive here, but here I probably could less aggressive here because that doesn't earn too much for me. I can allocate a little bit to here and move a little bit to here. So that actually can give me more premium here in the month if it didn't go up, okay? But like, let's see if we don't want to lose ETH position, we should do all our ETH into the last strike, all the 20 ETH here, right? Although we didn't earn much here, but we got like this 12% DOPIX, DPX farming yield. So here, when I do the strategy a little bit more aggressive, let's look at this from a practical result. Here I get this together. I have about like 0.4 Ether together against 20 Ether I deposited into the smart contract. So that means I have about like 2%, right? 2% for a single month for Ether alone. And this 2% annualized, you got probably 25 to 30%. Plus this 12, you got like 30 to 40% annualized returns. Okay, so that's very, very high for Ether denominated farming rewards. Okay, but here still you're risking your ETH. You're risking your ETH here. Okay, so the strategy too is actually, you know, put a little bit more ETH into the lower strike for the call Okay, so here it's like it's all call. It's all call. Well, but the thing is, we have to decide if like for the months those ETH that ends up higher, a lot of the call option has been exercised, and we got a lot of USDC. How should we deal with the USDC? Shall we use USDC to buy ETH and then like and then redeposit it again, or what? I haven't think about that for a multi-month strategy, but for single months, you know, like if you want to be a little bit more, take a little more risk, you can earn definitely more premiums. And for strategy, that's kind of for stable coins, similar allocation for stable coins that I strike for. You know, here is, let's say it's, you know, 1900. If it's that low, I'd like to take to, you know, basically buy up Ethers in this bear market, expecting that can, you know, come back. But in the meantime, if it didn't go that down, I can earn the put option premiums. But right now, it seems to me, I'm sorry, here I did first strategy, that's for stable coins. But right now, like stable coins, the liquidity is not that big, and also, you know, like they don't have the farming reward. The reward is only from the from the curve itself. Let's see. Here we go. Oh, here's the puts. So you see here the farm APY, the 6.64 is from the curve to pool fee APY and the curve rewards. So Dopix hasn't put any farming allocation into the puts option. So I don't strongly suggest that we allocate stablecoins here until they put some farming rewards here, like what they have done to calls. Okay. Yeah. So, and also the liquidity is too small to take in large capital allocation. That's only have $1.3 million liquidity. It takes time to get mature for this market. So we will see. Yeah. So that's probably the end of my presentation. Any questions is welcome. Thanks.
Thank you. But an epoch is always a month or
yeah, always a month, except for the put option. They only have half months because they started in the middle of the month for the put option.
It's the end of the month or middle. It's always 1 month.
It started at the end of each month and end of each month. So that's like,
okay.
Yeah. And
okay.
This put is a little bit different because the put option product, they just put it up there in the middle of February. I remember it's February 15th. So this like put option only existed for probably 8 or 9 days. And tomorrow it will open up again. So tomorrow I will put some stable coins. I'll deposit the stable coins into Curve 2 pool first. And then you have to put the deposit the Curve 2 pool here. And funny things is for you to purchase the options, you have to use the same underlying assets to purchase the options. So for the put options, if you want to buy, so you have to first to deposit your stable coins into the Curve 2 pool and use the Curve 2 pool LP to buy the put options. That could create some barriers for the put option buyers. For call option, it's pretty straightforward. You use ETH to buy the call options. So the premiums come in ETH as well.
Okay. Yeah. Are there any questions in the room? I have no.
Yeah. So this strategy requires a little bit of kind of active management. If the price goes up beyond strike, right? But generally for Aladdin DAO, I will just suggest we put all our ETH into the far end of the strike, and then we can enjoy this, 12% farming APY from the DPIX, and we can sell the DPIX at the end of the month into ETH, and then accumulate our ETH, and then deposit into the far end again, right? And then like 12% ETH annualized return is kind of relatively, hard to find in this market. And even for the far end, you have 4% annualized return there, right? This 4% plus this 12%, you get 16%.
Yeah. Okay. So yeah,
The next
I think we have to.
Yeah, the next epoch starts tomorrow, right?
Yeah, the next epoch starts tomorrow. So the February is actually a very short month. Generally, it should have last for 30 days. But I mean, generally, it will open for 2 to 3 days for you to deposit your ETH or your Curve 2 pool as the underlying assets. And then the window will close and people will start to buy options. So like for each cycle, for a full cycle, you have the opening window for people to deposit the underlying assets into the protocol, and then the window closed, and then people can start to buy options up to the capacity for how much amount like people deposited into the contract.
This is very helpful. I'm going to try it out tomorrow.
Yeah, it's very interesting, but it's really hard to predict how much premiums you can collect because people kind of buy the options through the whole process of the epoch, and the option price is calculated based on Black-Scholes models and given the parameters of the time they buy the options.
Understood.
But seems like people for the kind of people are crazy for ETH call options. I don't understand people that buy, like call options when price is actually above the strike, because there's no point. You can go for futures, but people still buy here. So I guess the call option people here, the people whoever buy the call option here is, I don't know.
Why is that?
Because, like Tetra Node is tweeting. That's the only reason I can get. So so this kind of ETH call option is basically every time the capacity is used up. Last month when I checked, it's used up as well. But for all other products, the capacity, there's a lot of capacity left.
So is there like when the start of an epoch, is there like an auction for those who deposit, or is it like ongoing through the epoch where like call buyers
you have
come in?
You have 2 to 3 days. I believe last time you have 2 days to deposit your ETH into the smart contract for how much ETH you deposit. So that's the capacity that option buyers can buy. So there's no auction for like capacity you can deposit.
Okay, so the capacity is just based on how many people put in to buy through that window.
Put into the collateral. Put into the underlying assets contract.
Right. Okay.
Yeah.
Okay.
So it's kind of funny, very like, random thing, right? You don't know the capacity. You don't know when people buy. So
yeah, and
they simplify the products into a very intuitive product design. So that's why I guess this kind of works.
Yeah.
Other option products are too complicated.
Yeah, under the hood, they are pretty complicated for sure. So buyers, they just sort of all get like the same price just under a Black-Scholes model, like for whatever strike they're looking to buy.
Yes. So basically here you want to buy and say available. Okay, then like how much option size you want, how much you want to buy, and here's the option price, right? And then you just buy for whatever, like the strike. You can select strike here. Right? Yeah. So that's.
I'd be curious how that pricing compares to like the vaults and the like just sort of like Deribit prices, for example, something like that.
Oh,
but I guess if they're getting like farm APY.
Yeah, but I think I asked the CM. They said it's used the Black-Scholes models, and the parameters are, there's an oracle that's from the central exchange that they are partnered with, that they input into the Black-Scholes models. So I guess it can be a little bit different from the deribit, because deribit there's a market-driven kind of
it's order book,
mechanism,
so
like the bid-ask spread, right? Here is kind of purely calculated from the mathematical models.
Okay. Yeah, I was just curious just to see like how, I guess, liquidity is for the options pools if you're relying on people to come in as buyers.
Yeah,
because
here
most of the other
I sense
things are like
the
auctions to
buyers
market
here are not
makers.
reasonable buyers. They are not like
Yeah.
The
Not a
behavior
huge
is kind
reason
of
to be like
weird,
a
because when
buyer
I
on these
track this
platforms.
out, it's like, so I'll describe a little bit here, you know, how the capacity is used up. So it started like 2,500 at the beginning of the month, and soon the price go up, and people, the 2,500 strike, only 1/3 is filled in. Okay, and then like the price goes up to 3,000. That's 3,000 is not fill up, is like 1/3 fill up. But 3,500 is, you know, soon 100% filled, and and similar for 4,000, because people is kind of extrapolate this uptrend into a future trend. People think, okay, for the full February, this price can go up. So people are buying load up like options for 3,500, 4,000. And then the price can start to turn, you know, pivot, price goes down, and price goes down below 3,000, close to the end of the month. And then the 3,000 options are fully loaded, compared to 1/3. And then like 2,500 are soon like kind of fully loaded. So it's quite weird to me, you know, that people kind of the way people buy options. People is kind of, you know, are guessing the trend. So, you know, so that's kind of the best option buyers you want. They are gamblers. They're not arbitragers.
Okay. Thank you for this presentation.
Okay. Any more questions?
So, yeah, I think we need the last few minutes in this call to Charlene
all right.
explaining
I'll give back to you.
side.
I'll give it back to you. Stop sharing.
Yeah.
Thanks,
Thank you
Martin. Thanks
very
for the
much.
question, Cody.
Cool.
Thanks.
Thank you. So,
Okay.
yeah, Charlene will update us on the.
Yeah, it's coming to the end of the hour. I will try to be quick. Just want to give people a quick update that we have actually created a new product called Concentrator. So Concentrator helps convex and curve maxis to earn more CRV and CDX. And this product is in line with Aladdin DAO's long-only philosophy. And just the way how it works, it just harvests the rewards from convex vaults and the reinvest and auto compounds in convex CRV staking pool. So Concentrator just, you know, helps to boost convex vault APYs by the CRV staking rate. Currently, it's about 45%. So this product is, you know, inspired by discussions with you know, Boule Council about convex many times. So we have multiple Boule members proposed various convex strategies and votes, until we have iterated on top of them and just, you know, added this compounding feature to maximize yields for convex and curve farmers. So, you know, this is an experiment just, you know, to create product based on protocols that the Boule Council has high confidence in, and also leverage Aladdin's dev powers and our long-only philosophy. So, and we think that Concentrator is a meaningful experiment because it's also a demonstration of, you know, how we implement a strategy with technical value add as a platform. And this also, you know, help us to build up revenue stream for the DAO. So, and timing wise, we're getting security audits done this week, and we're looking to launch as early as next week. And we'll keep the Boule Council and community posted on the progress. And I think in the time being, and if, you know, the Boule members can help us to connect to the key persons in convex and curve communities, and help us to raise profile and awareness in that ecosystem. That will be just super helpful. See if anyone has any questions.
No questions. Did you, on the timeline side? Yeah, looking forward for this because I think the convex curve pool is one of the cornerstones of DeFi, and going to make a product for this area is a chance to take, and it's still open. So yeah.
Yeah. So
So we're going close to call.
Yeah, I think why don't we end the call for today because it's already ended of
Yes.
the hour, and
Yeah.
I think we'll reach out to also to the Boule members who can't make the meeting today, and try to get feedback from them as well.
Okay, so thank you for joining. This has been the research call for today, and see us next week. Next week we have the last research call in this round, and then we're going to have the voting, as said, about all the all the strategies Boule members proposed, and then we're going to have new Boule members who are candidates for the Boule presenting their themselves and the project starting in 2 weeks. So thank you for joining and have a good day. Bye.
Thanks, guys.
Thanks, bye.
Thank you,
Waiting
everybody.
for the new product.
Okay, bye.